please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The show where we take stock of the week gone by and prepare you, more importantly, for the next one that's coming up. I'm Surabhi Upadhyay, and with me is Prashant Nair. Now, the week gone by was anything but easy for the bulls. In fact, towards the end of it, we had some pretty decisive sell-down days. Hi, Prashant. It hasn't gone according to expectations, at least not from the bulls' point of view.
Not according to plan. I mean, if there was a plan, but yeah. Oh, absolutely. I think, for the week, we basically end with just to quickly recap, 2.6% cut for the week. Financials worst hit. Lots of confusion about what's going to happen to yields, cost of money, is it going to go up? But I think even if it doesn't go up, one thing people are starting to reconcile themselves with is the fact that maybe it's not falling anymore. I mean, that the rate easing cycle is now maybe behind us. Even if you plot the Nifty on any cycle and you plot the yield on the same chart, I mean, cost of money going down has usually always coincided with markets doing very well. Now, if the cost of money stops getting cheaper, what does it do to markets? I think that is a question many people are asking. There is also this anxiety that global markets continue to do well. I mean, the anxiety is not that they're doing well. The anxiety is that we're not participating. I mean, so it's not providing the much needed lift here in India. And I think this week, the last 10 days is clear evidence of that. And also many trades that people thought were a given. I mean, buying financials on dip, high quality, good quality financials on dip, and that would always work. Well, it ain't working anymore. So I think it just kind of sort of summarizes the week that we had. Pretty calm towards the first 3 days, but Thursday and Friday, really took out all stops.
Absolutely, yes. And we saw the brunt of the selling pressure come in on the financials, as Prashant also pointed out, because of the fact that those elevated yields and talk of interest rate increases, maybe a slightly hawkish RBI next week, that really soured sentiment, especially on Thursday and Friday. Well, to discuss all of those cues, the week gone by and the triggers ahead, we have with us Rahul Chadha, Co-Chief Investment Officer at Mirae Asset Global Investment. Thank you so much, Rahul, for joining us on the show today. Now, we have been in this range of around 300, 350 odd points for a while, and it seems that now it's decisively breaking on the downsides. Your thoughts? Is the consolidation over? Are we looking at a deeper correction ahead?
I think markets have done well this year, and they're up close to about 35% from an MSCI India perspective, and that's where markets are taking a breather. If you look across the region, we've seen markets give away part of the gains after a strong 2017. So it's but natural for Indian markets also to consolidate this backdrop. And I think what happens in kind of a coming months is, as people get confidence that this recovery builds on itself, quarterly earnings improve, we see earnings upgrade for the markets. Hopefully the markets takes a next leg up somewhere in the first quarter of next year.
Mm-hmm. Rahul, do you see any triggers, at all, which might, if we are in a downtrend, or in intermediate short-term downtrend, any triggers along the way which might provide some support?
Okay, so if you look from an emerging market, what's happening is you look at overall multiples of the emerging markets, it's about 1.6 times a mean multiple, which is last 40 years multiple is somewhere around 1.7, 1.8 times price to book. So markets are not that expensive. You're seeing a synchronous global growth. Obviously, that benefits EMs, including India. And what that means is your nominal GDP picks up. As your nominal GDP picks up, corporate revenues would pick up. The good companies would do better than the others, market share gain stories, etc. And that would play out in earnings. So as people get more confidence on earnings recovery, you will see more allocations from the foreigners towards emerging markets, including India. And obviously, we've seen retail investors who've been increasing their allocation to the domestic equities.
Rahul, what sort of earnings recovery are you factoring in? What have you penciled in, say, for the remainder of this year, FY18, and looking forward to FY19?
Yeah, I think 19 is a fair number to look at, because 18 you're left with just one quarter, and you've had last 3-4 quarters where one's been impacted by demon and the negative impacts of GST. So if you look at 19, the numbers are anywhere between 18 to 20% plus. And should those numbers play out, you'll have selective opportunities in sectors such as financials, consumer discretionary, including autos, etc., and even parts of industrials.
So Rahul, I mean, would you, growth versus value, that old question, I mean, where are you on this one in the Indian context?
Okay, I think it's kind of an horses for courses, as they say, because when you look at some of these growth names, they kind of a price for perfection. If you have NBFCs which are trading at 30 times, 18 months forward earnings, and with balance sheets which are about $10 billion, there's a limit to kind of a growth they can have on those size. So I think clearly these are great companies, but they'll go through their own periods of time correction. At the same time, a good example is the telecom sector. We've seen consolidation of the sector. Market share between top three is close to about 75%. You've seen first signs of price improve. There's a money-making opportunity over there. So it goes very stock specific. See, in the laggards in industrial space, where nothing's happened for 10 years, should you see order pickup happen for these names, you can get meaningful upsides. So I think one's got to be very stock specific in this case.
Okay. Rahul, you mentioned, financials. So what is the specific view there on financials and NBFCs? I mean, they are the ones that are really seeing the sell down now after the huge rally. So have you been looking at, let's say, pairing positions on some of the private sector banks or the NBFCs?
Yeah, so I think some of these NBFCs have run too hard, so one would like to take some money off the table here and add to some select corporate banks, add to some select consumer discretionary, for that matter, even telecom, which looks interesting. Obviously, we've been adding over the last 6 months, but still looks interesting here. So that's something one would do selectively. On the whole, again, after going through a period of this time correction, these consumer banks, as they're compounding their book by about 20-25%, would continue to give those returns to the investors. Outside that, there's a big opportunity in consumer discretionary, particularly sector-leading companies who are benefiting from market share gains, who are benefiting from a consumer shift towards, let's say, the discretionary consumption. I think these names continue to be on an accelerated growth path, and market is going to keep rewarding them for that.
Let me ask you, since you are positive on telecom as a space, let me ask you, what do you see there? I mean, are you seeing tariffs broadly going up the coming year?
Okay, so the prime thesis or hypothesis here is that the challenger here eventually has to earn some reasonable return on the capital deployed. And as they kind of reconcile to their market share, 15-20%, etc., in next couple of quarters, you'll see pricing go reasonable, or even if the pricing is steady. I mean, we've seen in telecom sectors, pricing historically is corrected by 10-15% every year. What you'll see is the growth in the data traffic more than making up for it. So I think that's where you get the revenue growth that look at these level of pricing, the data elasticity plays out, and you get strong revenue growth largely led by data. And as that happens, you'll see operating leverage play through, and that's where you get a strong earnings recovery over the next 2-3 years.
Okay, Rahul, coming to some of the next triggers. Now, obviously, market is in a fairly sort of jittery mode right now. So how critical is the Gujarat outcome going to be? And for a minute, hypothetically, let's say if there were to be an adverse case reaction, which the market is not factoring in, then would it be a very serious blow to the market?
I think what happens is, obviously, it tempers the rally, because should the government not get the desired mandate in Gujarat elections, there would be a lot of fears in terms of the SOPs, or the handouts would be given in run-up to the national elections. Already we've seen our fiscal deficit targets being already met for the year when we are just in early December. So market would be worried on fiscal deficit. So I think clearly the pressure would come either through currency or your bond yields going up. So that may impact the market, obviously.
In terms of allocations and foreign money, FIs came back last month, and they bought. Local investors have been buying, but we've had fairly stiff competitions from markets like South Korea, etc., which is a market which has done well. From a EM perspective, EM allocation perspective, as we head into December and the next year, how do you see India placed? Okay.
I think what happens is Korea would continue to get more allocations. Early this year, there were concerns, fears about North Korea, the geopolitical stalemate happening, but that's not reached a flashpoint. And again, as you see, things have kind of are relatively benign on that front. What we've also seen is Korea benefit from this global economic recovery. Corporate governance is on the improve with the new government coming over there. Payout ratios are improving. So Korea would continue to be overweight in our portfolio. I think what changes in 18 is with PBOC in China tightening the domestic monetary conditions. Money would come out of China and probably move to India in 2018, because what happens in 18 is China would kind of slow down from what they've seen in 17 in terms of the GDP growth numbers, and India accelerates. So China has been a big overweight across funds. I think people would do a bit of a top slicing in China and use it to fund reasonably priced names in India.
Okay, finally then, Rahul, do you see any risks on the horizon to the mother market rally? I mean, that's been a mega move, and even this week, I mean, US markets up 3.5%. Are there any risks there, or do you see that trend intact? And if the US rally continues, what does it really mean for emerging markets like India? Because we have beaten our own tune on the downside.
Okay. See, what happens in the US is hopefully if these tax cuts gets passed through, the much needed leg of this investment cycle revival picks up in US, and that is very important for this rally to kind of continue. But look, in US what's happened is most of these corporates have exhausted their capacity utilization, so they need to kind of embark on a fresh round of capex, and what it means is the ROEs would dampen over there. So from a US market perspective, probably financials do well as the NIMs expand, but overall market would lag EMs. Because what happens in EMs is this operating leverage story has got long way to go, because capacity utilizations across most EMs are 65 to 70%. As we talk to investors, this year has been a year where people have cut their EM underweight, or kind of cut their EM underweight and got it to about a neutral. I think next year is going to be the year where they take their EM exposures to an overweight level. So EMs are good for now. I think 2019 is where there would be some risk from a global growth slowdown perspective, but I think 18 should be a fine year.
You're with us here on Taking Stock. Let's look ahead now with the 2.6% correction that we've had in the week gone by. What are the prospects for the market in the week ahead? Ashwini Gujral is with us. Ashwini Gujral has been telling us through the course of last week that 10,100 is an important number on the Nifty, and the market barely closed above it. I mean, the low last week was 10,108. Ashwini, how are things looking for the coming week?
See, basically in the last 2 days, you've taken out 3 weeks worth of action on the left. So my sense is that 10,100 is basically a formality. Even if we do get a bounce, it will be fairly shallow. And you know, if a strong bounce was coming, the market probably would have bounced in anticipation in the closing hours today, but that does not seem to be the case. Even if you get a 40-50 point bounce, that should get shorted and you'll probably go lower, and the focus will again remain on the financials and the bank Nifty, etc. 9,700 is the 200-day moving average, so now that becomes the next port of call for the Nifty.
Okay, the Nifty bank looks as vulnerable, Ashwini, and you know, in terms of trading ideas, and in that case, what would you work with for next week?
See, bank Nifty is the one which is sitting on a bigger rally and bigger outperformance. I mean, just as a rule in markets, whatever outperforms, that also gets hit the hardest, and this time the news is related to, you know, financials and fiscal deficit, etc. If Nifty gets to 9,700, I wouldn't be surprised if banks get very close to 24,000. So 1,000, 1,100 points can easily go, and a lot of that, you know, PSU bank rally will get taken back. Now, meanwhile, you know, if people want things that, you know, they can buy into as the markets fall, Rupa is a buy with a stop of 470, target of 510. This is coming out off of its 200-day moving average. Nice portfolio type stock. Jubilant Life also has bottomed out. That is a buy with a stop of 680, target of 715. And Voltas, maybe you can sell with a stop of 626, target of 600. Today, all day, I have recommended short on financials and PSU banks, etc. That short remains.
I mean, but if one is not already short that space, in that space, the coming week, does it make sense? to do that?
Given that they're all sitting on 40-50% rallies, I would think any sort of bounce will now lead, long positions will exit. The market will not fall because people are going short. It's because people are long and those positions will start losing serious amount of money. That is why, these banks will fall. So any sort of bounce you get, 1.5-2%, just go ahead and short these banks.
Fair enough. Ashwini, we have some people tweeting in with questions, understandable given the kind of market that we have. Vivek has 400 shares of Indiabulls Housing. He bought them at 12.10 and he wants a short-term view on the stock. When you've already mentioned that whatever has gone up the sharpest, that looks most vulnerable. So given his price at 12.10, now what's the view?
See, if short-term is next 2 weeks, there is going to be pain. And the best thing to do is, if you cannot take pain, get out, because easily 1200 can become 950. But if you are an investor type of a person, then maybe if you average down, maybe if it comes to closer to 1000, if you can average down there, then at some point, this will remain a bull market. But over the short run, there will be pain. So be ready for that. And if you can't take it, if it's a futures position, etc., you'll need to exit.
Okay, we have, Pharma, for example, was pretty poorly showing on Friday. Twitter user Neeraj has 500 shares of Glenmark Pharma. He's bought them at 580 rupees a share. Stock at about 550. Now he wants long-term view on the stock. Ashwini?
See, it's in a long-term bear market. 970 has become 560 and it continues to go down. So, I don't know when it turns. 580 can sometimes become 380. All that is possible. So just buying into something and thinking I am long term and hence at some point stock will go up, I don't think that's a good idea of buying. You should buy once something has turned. Maybe buy 10% more expensive, but buying something on the way down is a terrible idea. Particularly, do not buy stocks below their 200-day averages, because below those averages, they tend to make lower lows. Okay.
One more question, Ashwini. Avinash, who is also a Twitter user, he has shares of Hudco, bought them at 70 rupees a piece. We don't know the quantity, but we know the price, 70. He wants some advice on the stock. He's actually a long-term investor. Hudco listed this year itself, so not too much of trading history, but any suggestions?
It's basically flat stock. It's between 80 and 90, done totally nothing. So this could be a good time to get off and hold some cash. And as stocks come off, the good NBFCs like Bajaj Finance or L&T Finance, etc., they will come off and at some point bottom out. So maybe you can get into a better NBFC than a Hudco.
Okay. All right, Ashwini. We'll leave it on that note then. Thanks very much for joining in, taking all the questions as well. Happy weekend to you. We all could do with some rest, and then let's see how the market shapes up on Monday. But Prashant, I think some more views before we leave.
Oh, yes. We caught up with a couple of market guests through the course of the week. So let's leave you with some sound bites from Vibhav Kapoor, Atul Suri, Harsha Upadhyay weighing in on the markets. Thanks very much for staying with us. Have a good weekend. We'll see you back on Monday morning.
If there is a big disappointment in the Gujarat elections, then obviously I think the markets are going to take note of that. The whole sort of bull market that's going on and the increase in prices for so long now continuously is actually reflecting the expectations of investors that things are going to improve, both in terms of macros, the economy, the GDP numbers, and therefore the resultant increase in earnings that would come from it. So a lot of it is already factored in.
For me, the concern is not the overall market. For me, the concern is those pockets of people getting sucked into these kind of things, and a lot of unsavory stocks which may not deserve what's happening. A lot of stories are being cooked up, so you have to be really careful. Stick to quality, stick to leaders. Yes, you will have underperformance for a month or two, but these will ultimately emerge. And God forbid, if there's a larger correction, you know what happens in those spaces? You don't get exits. Stocks fall 50%. At least here you will relatively, outperform.
In this market, to expect that we are going to get value across the board is very, very difficult. So to that extent, our portfolio remains invested in stocks where we believe, at least from a longer term basis, there is steady earnings growth. Yes, on a relative basis, some of the stocks, some of the sectors may be higher than overall market valuations, but we still believe that as long as that steadiness in earnings continue, some of these sectors and stocks will continue to hold on to their level of valuations. So that's been our thesis.